Good afternoon, everybody. Welcome to TraderMerlin Show for your Monday edition of Bloody Monday out there for many people. Yes, I know I look really red today as well. I finally got the camera all set up, but I need to work on the color combinations and some stability here as it's probably bouncing as I hammer the desk on today's show. So anyway, I'm getting there, progressing, making sure this camera looks a little bit better for you guys as well as the content. So welcome. I'm going to talk a little bit about what happened on markets today. Not a lot of definitive catalysts which would have caused this big market sell-off other than we came into supply and we were due for a small correction, which I think a lot of you were expecting, but maybe it's just uncertainty down the road. So as I run through these top 7, I'll be keeping in mind that this week we start to have Jackson Hole Symposium, which of course is literally a cowboy town in Jackson Hole, Wyoming. Yes, it is a little podunk country town. It's actually a really cool little town. And there is a 40-year history where central bankers and major economists from around the world converge like bikers going to Sturgis. This is the economist Sturgis will be Jackson Hole. Hopefully it won't be as wild as Sturgis was this year, but it will definitely create some waves in the market. So I'm going to talk a little bit about that as we progress. But let's start things off by diving into the top 7 markets to start with. We'll work our way up from the bottom, and I will be walking you some of the trades I made today. I actually did sell some puts on gold, silver, NASDAQ, financials, and consumer staples today, or sorry, consumer discretionary. So, 5 trades right off the bat on this Monday. We'll see what happens for the remainder of the week, and I'll tell you more about those trades as we progress. There was just some beautiful premium out there to be had today. Here is our chart for the NASDAQ 100, which was the worst performer out there. 2.52% slide to 12,933.50. You can see on the NASDAQ futures a 335-point slide. That's pretty substantial, but notice you've got 2 giant, horrifically bad days in a row. I was actually eyeballing this area over here as a potential buy point anyway, so I sold at the money at the money puts, because I would be fine owning this. I feel like this is the pullback point, and you may get a bounce out of it. The options that I sold, just as reference, were on the triple Qs. What were the I'll have to bring up the triple Qs because I don't have it off the top of my head. I want to say 313 is what I sold at. 313. I collected over 1% premium. It was close to 1.5% premium, and just until Friday. So these are actually just the weeklies. All these I did for the week. Normally I do monthlies, but I just wanted to capitalize on some stuff this week and actually own some of this going long. So yeah, catching the falling knife, but I am catching the falling knife into that demand zone. It's also the retracement from the final breakout that we had here that rocked us to the upside on the triple Qs. So that was risky trade number 1 that I made. In 6th place, S&P 500, which also came right down to that same basic area of demand on the daily chart here. You see that huge red candle down 2%. It's funny, those candles look absolutely massive, and it's only 2%. It really could have been much, much worse, but 2% is fine coming into an area of demand. If we look at the pullback we've had on the S&P from the peak here, let me get my snap object on. From peak to trough, we've sold off roughly 4.5% in the past 4 trading sessions. So not the worst we've seen out there, but certainly a nice decline in the S&P. Markets is where will I get out? I will let those be assigned to me. If I get assigned by Friday, since it's already Monday, if I get assigned on those, I will just most likely sell covered calls against those positions, but we'll have to evaluate if I get assigned on Friday when the markets close, since those are weeklies. All right, moving on to the list. Number 5, Russell 2000. Again, same picture. Huge sell-off. 4 pretty much consecutive days in a row. One little green one here. But what's noteworthy for me on the Russell is we did break down below this yellow area. I kind of expected it to bounce there. It did not. Of course, it come back down to this lower area right on 1914. After that, there really isn't anything that I'm excited about until about 1813. So you got about 100 points down before I really start seeing an area on the Russell that would make me want to be a buyer, as opposed to some of this chop that we've seen in between that level. So that was your Russell 2000 today, down 1.95% to 1920. And rounding out the indexes, here's your Dow Jones Industrial Average, which has a ways to go. We actually had this red line at 33,255 where I was kind of anticipating it pulling back to. Well, we blew past that level, and this just goes to show you not everything works. You can make these trades and have all the plans and ideas we want. When they don't work, okay, no big deal, move on. Where's the next stop, is some of you may be asking. In my opinion, it's going to be right where the origin of this last big move was here, right around 32,800. You can see we had a big pop up on August 10th. That would be a logical retracement point, but you never know. All right, I'm going to move on to the top three. Podium time. Bronze medalist is digital gold with Bitcoin. Over the weekend was just brutal for Bitcoin and the whole crypto space. Significant losses. You had like double-digit losses over the weekend, which was pretty painful, especially for my portfolio. Where are we at now with it? Well, I guess I could get rid of this uptrend line here because that to me has been violated. It was looking great, really felt like it was going to pressure and build to the upside, but it just broke the opposite direction. And here we are now continuing in that prevailing trend, which I used to have across the tops here, a nice little downtrend line, which we were respecting, and now it seems to have disappeared. So, the initial thinking was, yes, we have this kind of shorter term uptrend from July, but it's still in a bigger picture time frame downtrend, which we've been talking a lot about last week, and the importance of bigger time frames. I was actually expecting it to rally up to this blue downtrend line and then start to have some pressure. Apparently got there a little bit early with regards to that downward pressure. So all eyes right now are on this 18,310 mark, which to me is that low point that goes all the way back to June of this year. If that's violated, then my $10,000 target is still in play. Crazy to believe. Yes, Margaret. It wasn't really a rising wedge in my opinion, and the reason it's just because these tops are pretty much flat. There was a very subtle difference between a rising wedge, which you could argue would be something like this, right? So there is your top of the rising wedge, and then you could say, well, here's your bottom. But I was looking at it, to me, a more popular and powerful formation is just where this is horizontal and runs across the tops. So I was calling this an ascending triangle, but they're pretty much telling you the same basic thing. And in this case, yeah, it's violated to the downside, which means those lows are absolutely in play at 18.3. And then after that, that's to be determined. But if we get below 18,300, notice on the daily chart, you do have not much as far as strong demand zones going back here into, let's call it 2020. Where are the really strong demand zones in here? I don't see any. Right, I see one area where I might be interested right around 13.8, but after that, you got it down to 11.5 and ultimately 10,000. So, not looking so good right now in that crypto space. Let's look at gold, which I did sell some puts today. I do want to be long gold, even though we are having a rising dollar, which we'll talk about the dollar and gold and inflation here in a little bit and kind of the relationships. This is definitely a speculative trade, but I'm happy owning gold and silver. My silver was taken away from me on Friday with the calls that I sold. I sold the 1750 calls against my position, and I was executed, or silver closed at 1755. So all in all, it was a great trade for me. I would have only made a nickel if I held the spot, but I made a lot more than that by holding or by selling the calls. Here is what I have with gold today. I sold the 161.50. So let me bring up GLD just so you guys can see the trade and I can explain it. I sold the 161.50 today, and part of the reason for that was I expected it to come back and fill this gap, right? We were already kind of closing it on the previous trading session. Today, nice gap down, close the gap officially. I think there's a lot of people that will be looking at that price point as a potential entry for gold. So I sold puts, which basically says I'm willing to be a buyer at 161.50. We're currently at 161.71 in the after hour session. So these are for Friday. And on those 151 puts, I collected $2.35 worth of premium. So, it's like a 1.6% rate of return to buy something, or to commit myself to buy something that I wanted to own anyway. And 161.50 was a decent price for me on GLD. So we'll wait and see what happens on Friday. If I get it, great. If I don't, great. I'm going to be happy either way on this trade, and that's the beauty for me for selling options. Now, some of you may be looking at this thinking, well, Merlin, why didn't you go a little bit deeper? Why take such a risk? Well, because I sold the weeklies, the premium was just significantly higher to go at the money. I could have certainly sold the 160s, but then I would have gotten a lot less. It was actually, I think, under 1% rate of returns, like 0.7% rate of return if I went with the 160s. In this case, if I'm buying the 161.50 and I earn $2.35 per contract, well, that's a much higher rate of return, and that's what I was looking for, being rewarded for something that I actually wanted to be in anyway. So that's gold. The big picture isn't that great. You do have this prevailing big picture downtrend. The dollar is not helping this whatsoever. And and we'll see if that changes. And I'll explain why I'm taking this really aggressive stance on it, kind of going against many different factors here. Now, let me do the last one, and then we'll go back into the dollar index and explain why, inflation and gold and all that stuff. So here is your crude oil chart on the day. $90.59 is where we closed at. Was really happy to fill up my tank for $5.19 this weekend here in sunny California. Only a 0.17% gain to the upside, although it had a pretty long bottoming tail on it today, going all the way down to those lows we saw from last week. So a retest, buyer stepping in. Anybody's guess as to where this one could be going. I could contend that it's coming up near its downtrend line and should be selling off. You could also make the argument that it just bounced off of demand and may rally even higher. So I still think that 93.64 is still in play for a retest here to the upside. So there is your top 7 markets. The big villain out there for the markets is this bad boy. I've been expressing my bullishness on the dollar index. You guys can see we came back right into this area of demand, not once but twice, and now ripping out of it aggressively, which leads me to believe it's a lot of expectation about what the Fed is going to be saying and doing at the Jackson Hole Symposium. Now, let me bring on my orange face here until I dial in my colors and talk a little bit about the Jackson Hole Symposium. So for those of you who may know, this is obviously in Jackson Hole, Wyoming, a beautiful part of the country, great skiing as well, just a fun little town. But for some reason they chose Jackson Hole. There is history to it, but I don't know all those details. And August 25th through 27th, so basically coming up here this week, the 25th being on Thursday, Friday, and Saturday is when that conference is taking place. And right now I think what you're seeing is, I guess, expectation that the Fed may say certain things about the market going forward. Like what type of things? Well, I'll read you some of the topics that they've covered in the past. Actually, you know what? Just for fun, I will actually bring it up here and let you guys read. I'll show them to you, and then I'll read them as well for those who might be listening to the podcast. But here's what we've got cooking. In 2016, when they all met, it was designing resilient monetary policy frameworks for the future. Okay, well, that was in the period of a great bull market. 2017. Fostering a dynamic global economy. Well, that was 2017, and they did. I think the global economy was doing rather well at that point. 2018, changing market structure and implications for monetary policy. Okay, maybe they saw the writing on the wall that things were changing a little bit. Bravo. I don't know if they really did the right thing there, but that was their topic. 2019, challenges for monetary policy. Okay. 2020, navigating the decade ahead, implications for monetary policy. So I kind of feel like they just say the same thing over and over again because 2 years before they pretty much talked about implications for monetary policy. 2021, macroeconomic policy in an uneven economy. So that was rather interesting as we saw really not divide per se, but all of a sudden big differences in income and earnings and just stability with regards to people around the world. And then the new one, I think is a rather interesting topic. The topic is reassessing constraints on the economy and policy. So this one seems to be a little bit of a change of pace. It says reassessing constraints. So in my mind, what this kind of sounds like that's setting the table for is they have been really aggressive with monetary policy because of they need to kind of help the economy get back on track, right? Let's get out of the COVID thing. Let's be aggressive and do all sorts of money printing. Now, I think it's reassessing constraints on the economy and policy, meaning they're going to have to start cutting back. So what are the prognosis, the hypothesis of quantitative tightening, which they've started doing, of removing dollars from supply? I think this is now going to be an open discussion with economists as well as central bankers saying, hey, how is this all going to impact us? Now, honestly, they should have thought about that before. Maybe they should have done this a couple years ago. But to me, that is going to be the gist of it. Now, what I think you're going to get are hints from Jerome Powell and any of the other major central bankers about the truth about their economy and how it might be impacted by the actions that they're taking right now, right? Like really, what are the implications of rising rates? Well, it's easy to predict when it's one-dimensional. So, for example, if I'm making a pasta dish, right, and I throw in a little bit of pepper, I know what the change is going to be. I can kind of feel what that change is going to be because I know what the flavor of pepper does. But in essence, what the central bankers have been doing in this rising rate environments is they raise rates. Okay, that's throwing in the pepper. But they're also unwinding billions of dollars worth of bonds. Now I'm throwing in a handful of salt. And they're also removing money supply. Now I'm throwing in oregano and thyme, throwing all these different things. So I don't exactly know what the impact's going to be. So I know it's a terrible analogy. I am probably the master of horrible analogies, but I think you guys can see the point. These central bankers are making lots of decisions and have been making lots of decisions, which I don't think we fully felt the impacts of. And I think that this will give them a better idea of what's going on, or at least what they think is going on. Now, the markets, I think, are expecting not a rosy prognosis for all of the impacts with regards to reassessing constraints. As we can see on some of these market charts here, let me bring up the chart again, that dollar index surging. People feeling a lot of optimism in that US dollar. That may have to do with more rising rates prospects going forward. Remember, the higher the Fed funds rate is, generally the higher the carry trade is going to be, which means the dollar becomes even more desirable. Now, what else do we have out there? Let's go look at what the bond market did today. Let's just check out the little bondies. Bond market rallying back up. I'm really kind of surprised to see it come all the way back up to this level, although that is somewhat normal on a head and shoulders pattern break. I still have this head and shoulders pattern here. I will leave it there until this is violated. In my opinion, when we get back above, let's say 3.15, then this head and shoulders pattern is violated, and we'll start to look back more towards the bullish side. But you notice we've gone from a low back here on the 2nd of August. So just a few weeks ago, we were down at around 2.5%. Now we're back up to over 3. So we've increased a half a percentage point in just a month. Now that doesn't seem like a lot. However, it's a sign of a smaller trend here. And if that keeps on going, then all of a sudden, we're looking back at 3.5%, which is a question I have from a viewer, which I'll address in a little bit. Higher rates, obviously, constrict the economy. Shooting dollar surging like we've been seeing on that Dixie time frame. That also hurts the economy. So these are fairly negative factors, and I think that the reaction we saw by the equity markets today was simply that, saying, okay, we've had this pretty big, what some would call a bear market rally that may be done right now. I'm going to play it to the long side until I'm proven wrong, and for me to get proven wrong is basically down below on the NASDAQ, for example, like 12,050 would probably be my, okay, I'm out kind of point, because it would break below this trend line here. But I'll have to wait with it. I've got to go with whatever the trends are. That's how I trade well, is playing directionally and going with whatever trend. So there we go to the upside here. Again, Jackson Hole will be 25th through the 27th of this week. So be careful out there. You should start to see, maybe this week I'll bring up the schedules of who's going to be speaking when, but it is kind of important to see who's going to be on stage and what's going on. Remember, it's not just that Jerome Powell's there. It's that he's talking and working with other central bankers and maybe getting some new ideas, maybe finding something out about their economies or even his own that could impact our markets and create much, much bigger waves. We are at a point right now with these equity indexes that I just don't know. It looks like we're in a bigger picture downtrend. We had a big retracement that, for all intents and purposes, did reverse the trend because it did break through a pivot high right here. This pivot high that you can see on the NASDAQ goes back to June 1st, but I'll bring up the NASDAQ since that's a bigger market. Our pivot high, same thing. We broke above that. Well, that technically is a reversal. Well, it's a reversal of that trend, but now this blue line across the top, where we smack dab ran into, is the bigger picture time frame. So it's tough. We can convince ourselves of really anything when you look at charts long enough. One of my old mentors used to say, if you torture the charts long enough, they'll tell you anything that you want to hear, which I think is a great statement because you can look at it and come up with convincing arguments for going long. You can look at it and come up with convincing arguments for going short. And my personal opinion is, whatever direction you decide to go with, great, go with it. If you want to go long, cool. Have a plan, have rules in place, and if you take some losses, make them small. If you're going short, great, cool. You got your reasons. If you have it going short, make sure you got a plan. Have your stop losses in place. Don't lose a lot. Simple. It's funny because some people get on my case, go, you're bullish or you're bearish. Who cares? You can have your own opinion. It's fine. Jerome and his band of misfits are sure to screw things up. Well, who knows? I want to deep down big. I really want to give them credit. I want to give them credit because, where would we be if they didn't do all the quantitative easing? And where would the financial markets be if we didn't get all that bailout money and Operation Twist and QE1, 2, 3? What would happen to our economy if we didn't have that? Now, personally, I believe that we would be in a much better place in the long term, right? But instead, what we've done is the market was injured and we just pumped it full of drugs. And now it's addicted to those drugs. Whereas, you maybe put them on a little bit penicillin to, heal them up or something, and then let the body heal naturally. And I think that if you heal naturally, we would have come out of this much stronger. Right now, I just feel like our markets and economy and businesses are just literally like crack fiends. Just, give me another hit, man. Give me another hit. Where's my stimulus checks? I don't know what to do. I'm going to lower my earnings forecast because I'm not going to make that. You got to give me some money, man. That's kind of what I feel. So who knows if they're going to screw things up. I like to give them the benefit of the doubt, but I'm kind of in your camp, Big Eb. I think they totally screwed things up. Are the Jackson Holers aware who actually hires, fires, buys, sells to drive the economy? It's okay, Tom. You can vent all you want. I wish I could turn the mic on for you so you could have your say. The Federal Reserve is this, in my opinion, and this is my jaded opinion, it's just this elitist group that represents those who are making all the money. And they're the ones who get to make the decisions. And unfortunately, you and I have no recourse. We have no real influence there. We have no say. Yeah, you can vote, but let's be honest. If you vote for the president, does that really mean it's going to impact the Federal Reserve? Even if you trust the election system, I don't believe it does. So, we are just here trying to figure out how we can capitalize on the actions of the Fed and central bankers. And unfortunately, I think a lot of people are going to get hurt by those actions in the long term. So let me run through a couple of questions here. Let me real quickly do this one because I told you guys I went long on gold and silver today. I actually like my silver trade better. I got about 2% rate of return holding till Friday. So, a 4-day trade because I pretty much I sold my my puts near the end of the day today. But basically a 4-day trade is going to get me almost 2%. Not too shabby. And I sold the at the money. I'll share this chart with you. SLV. So you can see I'm actually at that money right now. 1750 is where I sold those puts. And the main reason I did that, guys, is there was a lot of volatility. The premium was very high, and I earned 32 cents by selling at 1750. So I'll put a line here that shows you my average price, and then I'll actually, before I do that, the level I really would like to buy at is down here, right around 1715, 1710. Right? That's the area I'd be comfortable with silver. But I sold the 1750s. And I'm like, wait a minute, well, isn't 1750 the price you're going to buy it at? Technically, yes. However, it's 1750 minus the premium that I collected. That would be my break-even cost. And that's going to be 1718. And now you notice that line is kind of right at that area that I'm interested in buying at. So, if I get exercise and I get put, I have 23 of these as we speak. So that's 2,300 shares of SLV. If I get put that on Friday, then great. I will on Monday. I'll sell some covered calls against that to lock in more profit. But that's the silver trade I made today. Now, I think a lot of people are going to look at me and go, Merlin, you've just been talking about how this dollar index looks so strong and is going to keep on rallying to the upside. Why would you do that? Well, I think it goes in the face. It flies in the face of traditional economics. Traditional economics says that gold is an inflation hedge, right? And I'm lumping silver in there together. Apologize, I keep elbowing the desk and I can see that my video is bouncing, so I'm going to try not to touch the desk until I get a better tripod here. Traditionally, it's viewed as a hedge, right? You guys have all heard that story that gold is an inflation hedge. Oh, we're hitting inflation, buy gold. Well, not necessarily. In theory, when you have the measures put in place to fight inflation, it generally hurts the dollar. So with that said, when the dollar falls, gold and silver rise. I don't know if it's necessarily a pure inflation hedge. From all the statistics I've seen, it really isn't like the perfect hedge against inflation. I don't think it was designed to be that. It's just this social construct that we've adopted over the years. It definitely has a lot to do with the dollar index. So Naum, who machine gun a dozen questions today. Naum, I hope you're here because thank you for all those questions. A lot of it's going to be based on your stuff today. And thank you, Malik. I know the camera is way better quality, but I need to fix some of the color settings here as well. Noam says, I thought gold was a hedge against inflation. What's going on with gold? Well, I think the problem with gold is we have so many other asset classes that are attractive. And what I mean by that is you have cryptocurrency, I think, is taking away some of the quote-unquote digital gold, the store of value, right? Gold is always believed to be this physical commodity that you can own, you can touch it, squeeze it, whatever you want, it's yours. And that's nice when you're looking at wanting to own something. Whereas you look at equity markets, you don't really own the S&P 500. You're not owning the NASDAQ or Apple or anything like that. It's you have a piece of paper. So there is that belief that you have this tangible asset there in gold that you could hold long term. Now notice the aggressive sell-off we've seen in gold over the past 6 trading sessions. It's been nothing but red. It came in right into the origin of this gap, and actually down here is even better at 17.19, in large part due to this move right here up in the dollar index. So part of the reason I did this, and we talked about this 2 weeks ago, says if we bounce off this 105 mark, then we're probably going to come back and challenge 109, and here we are. We are back at that 109 mark, and my gut tells me that historically, when you come back into these overhead supply levels like this, you'll see a little bit of a pullback. However, this momentum is monstrous right now. I mean, it's been 8 days in a row. Let's see, 3, 6, 7 days in a row of nothing but up. I do think you'll see a little bit of a pause, but I mean, that's a big gamble I'm taking on my part. Other people keep asking, well, where do you think it's going to go? I'm going to zoom out here to the weekly and see if we can find any levels. And this is the tough part, right? Where does it go? You can see that this 109 mark is really this congestion area that goes all the way back. Excuse me as I try to get the data here for you. All the way back to 2002. We're literally going back 20 years to find this stuff. Great. Now, I have one level mapped out, which is 113.80. And let me see real quick. Someone asked me about that one. That's Naum again. Naum says, where is the next supply level for the Dixie? In my opinion, 113.84. That right, call it 113.75, 113, 114, somewhere in that area. But you can see you had this aggressive drop, base, and then it just fell apart from there. And we are now just now 109. So we've got a long way to go. I know some people might say here at 110, maybe 111, but I think that your ultimate target is going to be 113 if we get a close above 109, a convincing close. All right, it's crazy. You got to go back 20 years to find these levels. And so many of you who have just started out trading the last few years probably are thinking, Merlin, that's 20 years ago. That doesn't mean anything. That doesn't matter. Yeah, it absolutely does. People are looking at those charts trying to find where did it turn in the past. And if that was going all the way back to 2002, so be it. People are going to start putting orders in there. So I'm expecting there to be a small little drop here in the dollar index, which should bode well for the put options that I'm in. I was expecting a little bounce here in some of the commodities as well. But longer term, I got to be careful. Because if this keeps on rallying, long-term holding gold and silver should actually be going the other way. Now, here is the important part, for me anyway. I believe silver and gold are going to do fine long-term. Maybe not in the next month or 6 months or 3 months or even the year. But looking at 4 or 5 years out, I think you'll be fine owning commodities like gold and silver long-term. Now, most people may not have that ability to hold on to positions that long. I will, if I end up holding these and getting gold and getting silver, I'll be selling calls against those positions, lowering my cost basis consistently every month, and maybe even weekly if I can get good enough premium just to commit to selling my shares at certain prices. So I plan on doing a lot more of this over the next couple weeks, which is going to be trading gold and silver, mostly silver because the premium is significantly higher. It's almost double on silver versus gold. Okay, fine. I'll trade more silver, but I did get some gold out there as well. And again, 161.50 is my strike price for gold for Friday, and 17.50 is for SLV. Hey, Chris, good to see you. Happy Monday. So there, I got Naum's. Where's the next supply level for the Dixie? I thought that it was hedge against inflation. What's going on with gold? Just I think it does tie more to the dollar versus more of what's going on with inflation. So I guess you could say it's an inverse dollar hedge. So if the dollar is looking really, really strong, short gold. If the dollar is looking really, really weak, which I don't see that happening right now or in the near-term future, then you should probably looking to be going, if the dollar is looking weak, you should be going long gold, right? So I'm kind of in a conundrum here myself with this position. I'm going against the dollar index, even though I'm going long gold and silver. Figure that one out. We'll figure out how that ends in the end. What else do I have here? Comments that came through the other day. Now, again, when I was younger and waiting on tables, I remember the maitre d' telling me that the house never loses money. This has been with me throughout my entire life. Yeah, you know what? If I had more time today, I actually wanted to... I think I want to do a show called The House Never Loses Money. And that's really what it's all about. And the average person is a gambler. You guys have seen a lot of people that'll pop up in here and chat, some random new people that jump in and, they throw out some random comment about some penny stock. And my gut just goes... You're going to lose, man. You're a gambler. You're walking up to the roulette table and saying, I'm putting everything on red. Well, you got a 49% chance of winning. You're going to lose over time, dude. Just keep playing that. You'll lose over time. It's mathematically the way the game is constructed. You might win 3-4 times in a row, but you play the rest of your life, you're going to lose money. The house builds these games so that we lose money. And I personally do think that trading is no different. I think that the trading world is built so the average retail investor loses money. It sounds very pessimistic and kind of counterintuitive. Like everyone should prosper from a rising economic market. Well, not necessarily. Those who prosper are the ones who built the system, and they're the casino. So Naum, that's a great topic. I think I may do something a little bit different, a little bit about that in the near future. Let's see. Naum, since I'm just going, this is the Naum show today. He says, if we get 3.5, will the banking industry stocks increase in value? So I also sold puts today on XLF, which is financials. So here's XLF. There's some old levels I got here. And my logo pellens. There you go. I like that. Toile respect. Let me just put this line up to my strike price on this one. So there's the put price I sold. This is a weekly. Let's go back to a daily so we can see some time frames. I sold the 33 puts today. Now we're only at 34.27, so that's not like it's a giant fall away from here. But these are actually for 30 days. So my XLF and XLY are for 30 days. I did not do these for weekly. These went a little bit longer term. But I collected over 1% on the XLFs, and which basically puts my average price, should I be executed, down at 32.58, which is right in this area where I'd want to buy anyway. Right? So I'm strategically using the premium I collect to get the spot that I want deeper in the zone and get my premium. Now, Naum says, if we get 3.5%, will the banking industry stocks increase in value? Unfortunately, I can't do side-by-side charts here, but let's just look at financials and see kind of what they've been doing, right? It feels like they've been on this aggressive slide. They turned the corner here, and now we're, I think you're at a point where it was due for a pullback. My guess is you're going to close this gap, maybe get to 33.75, possibly 33, and then start its next move up. To answer your question, if we get 3.5%, will the banking industry stocks increase in value? In theory, they should, because as the Fed funds rate gets bigger and that 10-year rate increases, it gives banks the more wiggle room with what they can earn on those loans. So, when the 10-year is really cheap, they can't really make a lot of money. It's not there. There's no meat on that bone per se. So let's go back and see what happened here last time, because we did recently have the 10-year at 3.5. So here's your 10-year at 3.5. The banking stocks didn't, and this was back on June 14th. So I'll go to XLF just to see what the banking stocks have done since June 14th. XLF, go June 14th, was pretty much the bottom. So as we peaked at $3.5% on the 10-year, that was kind of the bottom here for XLF, and it's been rising ever since. I personally sold these puts because I do think that the financials are going to perform a little bit better. I'm waiting for the pullback to buy into that dip on it, and generally it should increase the value. Here's the thing, Noam. I don't know all the business models for Wells Fargo, JP Morgan, Chase. I don't know their business models. Some operate a lot more from lending. Others are from using assets and selling instruments against those. There's all kinds of shady stuff going on behind the scenes at banks. If I was more astute and had more time, I would see who actually makes most of their profits from lending. And if I can find someone who makes most of their profits from lending, that's where I'd want to go, right? I'd want to be buying that specific bank. My guess is it would probably be somebody like JP Morgan Chase and Bank of America. So we can go look at BAC, right? Bank of America is a pretty big retail lender. Wells Fargo as well, but JP Morgan, one of the biggest ones out. I don't know why it keeps defaulting down there. Well, JP Morgan actually does not look very good right now. However, those would probably be my two candidates. Would you buy Citigroup where it is now? Yes. So I would buy Citigroup, Margaret, but you notice that it's really been sideways for, call it a month. If we ended up somewhere down below 50-50, I'd get out. Because to me, it's you can see this blue dotted line I drew here. That's the low that we saw back on August 2nd. And really, it's been up above that number for a month, maybe a little over a month. So, yeah, I'm okay with that. I think you actually have a decent demand zone here. But if things keep pulling down, then Citigroup's going to break that. And notice you've got the mother of unfilled gaps way down here that could bring it all the way back down to 44.50. Ouch. So don't want to be holding that one as it may plummet like that. So make sure if it does violate it, take a small loss on it, move on, and don't get upset if it rallies back up. Just know you protected yourself from taking that big loss, which is the most important piece in that situation. But sure, I do think that financials are going to start looking a little bit better with regards to their numbers. Now, of course, what's going to impact the banking sector? Hello, Jackson Hole Symposium. Anything that's discussed there can have a profound impact on what the FOMC does, right? And whatever the FOMC does, remember, it's just the FOMC is made up from banks. Of course, they're going to say things that are going to benefit themselves, and this is their biggest stage to collectively work together and say, okay, how can we make the banks bigger and stronger and make them more money? Now, of course, that's not what they're going to say. They're going to say, how can we collectively use the banking system to make the world a better financial system, to make it more inclusive for everybody so everybody has a shot at blah, 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 blah. They're really basically saying, we need to make the banks money because they're on the board. Got to change the rules and make it better for the banks. So I think, the long-winded answer to your question, I think if we get back to 3.5 on that 10-year, banks are probably going to do pretty good. If we get the Fed funds rate to increase at the next meeting, which I have not looked at it today, but this may be part of the reason why we saw. Let me go back here and I'll bring this up for you. It's the FOMC Fed funds futures. Here is the expectations for the September 21st meeting. Oh, would you look at that? It shifted. I still am in the camp, everybody. I am in the camp of 50 basis points. You can see right now it's a 45.5% chance. The new target is 75 basis points. It's moved up. And I'll scroll down here. You guys can see 1 week ago, there was only a 39% chance of a 75 basis point increase. Now it's 54. So that's shifting. I still will stay in the camp of 50 basis points. I think that just makes more sense given the fact we see slowing inflation. But I think that we'll have to just wait and see what comes out from Jackson Hole. Bottom line is, Thursday and Friday, be very, very careful with your trades. You might want to just go light on your positions. All right, how much time do I have left? I dropped my phone. I'm getting close. So let me real quickly go through a couple other questions here, and then I'll scroll through the chat because I saw some good ones. Thomasina says, I've heard that according to Chinese law, it is illegal for any foreigner to own any aspect of a Chinese business. To get around this, the Chinese government has created shell companies in the Cayman Islands with the same names as the companies on the New York Stock Exchange, example, Alibaba. Do you know if this is true? And if so, how well is it to fundamental traders who want to own equities in Chinese companies? So I don't know if that's true or not. I do believe that you can't own ownership as an individual in a Chinese company. However, let's be pretty blunt and honest. Who would want to own? And would anybody here, just because I have the power, I'm going to type in a question here. All right, there's the question. The question is, would you like to own a Chinese company? And I mean that as a foreigner, as someone who's out, as an American or Canadian, and we got some French people in here and Germans. Would you like to be an owner of a Chinese company and have your money in a Chinese company and say, I am an owner of that company? Just curious what you guys think. My skepticism, my mind tells me this. There are already 50,000 different instruments I can trade on the U.S. markets alone to help make me money. There's probably way more than 50,000. I'm literally just shooting from the hip. So I think that that's more than enough. But then I can go into markets that are transparent, operate off the same basic system that the U.S. ones do. I could go to the Euronext. I could go to Canadian markets, and all of a sudden, I've got hundreds of thousands of markets. Options, futures, commodities, real estate, ETFs, indexes, credit default swaps, cryptos. Why the hell do I have to buy in China? And I'm going to end the poll here just because I want to see the results. So 82% of you said no, and 12% said yes. Not that there's anything wrong with that. And Christy's right, 1.7 billion customers. Yes, that's awesome. But you have no control over what happens with those companies. They can immediately kick you out for whatever reason they want. China is totalitarian in a lot of their things. They will say, you're done, and just kick people out of the country. Now, granted, that could happen here as well, but there's a process. There isn't just the government just says and does everything they want. There is a process we have to go through, even though many of us don't trust our government. I personally would want nothing to do with a Chinese company. I would buy shares of Alibaba just because it's listed on New York Stock Exchange and I actually use Alibaba and I like Alibaba. But I don't think I'd ever want to be an owner of it. Now, could you go through shell companies? Yes, I've heard about people using shell companies through areas that are let's just say, agreeable to China. And maybe the Cayman Islands is one of those. But I don't know. Personally, I just think you have so many things. Why do you need to, take that gamble? And I totally agree with Christy. She says 1.7 billion customers. Well, so I can go to the Indian stock market too. I would trust the Indian government more than I would the Chinese government. Just history has a way of proving itself to me. So, and India's got, over 1 billion people as well. But look, how much better, I guess let me ask you this one. How much better would your rate of return be if you bought into a Chinese company and were literally at the whim of whatever the Chinese government told you could or could not do, and they could boot you at any moment, and they literally could just take your money and say, sorry, it's ours now. That company's ours. It's now a government company. You lost everything. Or going through the process that we talk about here, looking at supply and demand zones, looking at trends, evaluating, if you want to, the fundamentals of an American company and saying, hey, how is Apple's exposure to China? How is Tesla's exposure to China? And using those vehicles, which are probably not going to be shut down. Are you going to get that much more of an astronomical rate of return by buying a Chinese company? I personally don't think it's worth it. But that's just me. I'm jaded. I too wanted to know, but learning was a surprise to me. Yeah, that's cool. It's a good question. Also, Jack Ma. Oh, yeah, exactly. Guys, that's a good point. I mean, Jack Ma, he disappeared for a while. And now you have certain... Thanks, Tom. You made me laugh today. That was a good one. You have certain CEOs that are now being thrown in prison for things that they've done. No. I mean, look, I would love to learn Chinese, but I wouldn't want to be buying Chinese companies. Yes, I want to own, but weighing the risk reward. Exactly, Malik. It's all it is. And everything we do as a trader or investor, it's weighing those. All right, so Malik asked me a couple questions here early on. Not sure if this question was answered before, but how far can Fed go with rate hikes to achieve acceptable levels of inflation if inflation will have to have a new norm more than 2%? So it's a good question. Obviously the Fed's saying, hey, we want to have 2.5% inflation. That's their target. Well, we're nowhere near that, right? We're at 8.5%. My guess is the next couple months we may drop down to 6. By getting into September, October, maybe get into the 6 range. That'd be very aggressive, I think, but it could happen. Well, that means the rates are, right now at 250, but we're still at 6. At some point, the Fed funds rate needs to get above inflation. That's historically what has been. So I still think you're going to see them continue to raise, albeit not as aggressive with the 75 basis points. But how high could they go, Malik? I mean, all you got to do is look at a chart of the 1980s. The answer to that question, they'll go as high as they need to, right? They'll go as high as they need to. Now, the good news is we're not seeing 30, 40, 50% inflation. Thank goodness. We aren't in Zimbabwe, right? However, could we see the Fed funds rate get over 5%? Sure. And when we look at this, let me... give me a second here as I bring up some charts, since TJ is not doing the graphics for me. I want to show you maybe a historical picture of the Fed funds futures. I got to go out to September, and it's on the 21st, I believe, is the date. Here we go. So here is the Fed funds rate. You look at this. Look where we were back in 2006, 7, 8. A lot of people are like, there's no way we'll get to 5%. Man, we spent almost all of 2006 and early 2007 sitting at 5.3%. Zoom out even further, right? Here's back to 2000. We were up at 6.5. So we could absolutely go significantly higher. Now, of course, I think the main problem with going that high is, Jerome Powell doesn't want to have egg on his face. And if he raised all the way up to 6 real quick, he'd have egg on his face. It would make him look like he was, the worst guy on the earth. Well, look, he's got to fight inflation. He's got to do what he's got to do. And I think what's noteworthy here for me and for you as well is notice there is no point in visual history out of the last 22 years where we've seen rates being hiked as aggressively. That tells you that they are crapping their pants. And we are now at the peaks that we saw back in 2019, right? And that was, remember, this run up here that you see from 2015 when we came out of quantitative easing and started unwinding a little bit the balance sheet, getting back to normal. This market was robust and they were raising rates. Robust. The market was doing great in 2016, 17, 18, and they were raising rates. Well, this is a totally different situation. The markets are not robust. Markets have financial problems, but inflation is so high. This is the big problem for me. I don't think that 5% is off the table at all. If inflation does not moderate and we see it stay high, then the Fed will keep raising, 25 or 50 basis points per meeting until we get that Fed funds rate above the rate of inflation. That is the pain. How about 1987 style, like 14, 15, 16%? Yeah, it was crazy. Let's see when oil. Oh yeah, well, let's see. Who knows, Christy? You've got oil right now. We looked at crude oil earlier today. Let me just bring that chart back up. $90. The trend for the intermediate term is looking down to me. So I'm feeling optimistic that we're seeing the inflationary pressures on oil subside a little bit here, and that's certainly going to help the data. But longer term, this could just be a pullback to the trend line. I don't know. I don't know which way this is going to ultimately end up. I think the Fed is going to pivot back, chicken out, and get back to zero, and then QE. They might, Trader Larry 1. I think that the only way that they would chicken out is if inflation miraculously tanked. Like if all of a sudden, right now we went from 9.2 to 8.5 because of the last CPI and PPI numbers, right? You also have core PCE price index numbers coming out on Friday. Now that said, if all of a sudden that inflation number drops, surprising, let's say next month's CPI number comes out and all of a sudden we're down to 6%. That may cause the Fed to just raise 25 basis points. And they're going to see the ceiling is falling down. We're raising the floor. Okay, we don't need to raise that floor as fast because the ceiling's dropping much quicker, if that makes any sense. But if inflation ticks back up and stays high, they're going to have to raise their rates. Now, I do agree with you, Larry, that at some point, what will probably happen is if inflation continues to drop, the Fed's going to do whatever they can to get that Fed funds rate to zero again, right? That stimulates economy. That makes things grow. That artificially creates inflation. But either way, they want to get that number down because it looks good on their legacy as saying, we were good, pro-business, and look what the economy did under my reign. But yeah, it's a messed up world, I'll tell you that. Let's see. Is the price of gold falling based on political macro issues? I don't think it's necessarily political or macro issues. Personally, I don't think so. I think it's because of the U.S. dollar. The U.S. dollar is what's causing. The dollar's been so strong. Remember, if you want to buy ounces of gold, it's priced in U.S. dollars. You want to buy ounces of oil, it's priced in U.S. dollars. So, yeah, that puts a lot of pressure on these markets going forward. So let me wrap up here. I didn't take a look at your economic calendar for tomorrow or earnings. I've been just slammed today. But I will do so, and I will just bring it up here since I didn't have my slides. But here's what's going on for the 23rd. Actually, quite a bit of stuff going on for the markets. You see lots of flash services and manufacturing numbers coming out for the EU, for the British pound, and also for the United States. And then a number that I'm really, really curious to see what's going to happen with is the new home sales. Now, that's going to happen 1 hour before the markets open, so make sure you keep an eye on that one. Why? Because remember, home builders, they know what they're doing, and we've seen the trend completely change. Notice really since the peak or that bottom in 2020, we've been making lower lows and lower highs. So for 2 years, the number of new home sales has been declining. And remember, that's with mortgage rates unbelievably low, historically low. Never going to see those rates again. Well, now all of a sudden, those rates are 5, 6%, and who knows, we could see even higher. I'll go way back here to when the home builders were just surging and then fell apart. Notice that since 2009, we've really been on this beautiful uptrend, which all stalled and stopped in 2020. So I think you're actually going to see a more disappointing new home sales number just because people are starting to get priced out of that market, which of course could impact Toll Brothers, Lennar, KB Homes, and companies like that. So there you go. Builders aren't building. Exactly, no. And here's the thing. I like to think I'm smart. Home builders are way smarter than me. They know the inside and outside of every city in the United States. They've got land purchases. They know exactly where their profit margins are. And if they're not building and people aren't buying, then those stocks are going to take a hit. Now, they haven't yet. Well, actually, that's not true. They have. Here, look at just Toll. And they come out with earnings this week. I think, actually, they may come out tomorrow. I'll see if I can find that one. But Toll Brothers, pretty big decline there. You've got Lennar, right? Here's KB Homes. So they've definitely, taken a big haircut here, and the trend seems to be down. So, yeah, there you go. KB Homes. There's the KBH for you, Margaret. Why are we told this issue with inflation is due to $1,200, $24 stimulus checks? Like we didn't bail out the financial system. Yeah. Well, you have to make everybody believe that this was necessary. So, one of my favorite movies, and I won't ruin it. If you have not seen it, write this one down and watch it tonight. It's a great movie. It's one of those ones that literally at the last little bit of the movie, you feel like someone reaches out from the screen and slaps you across the face and you're going, oh my God, I had no idea. Watch The Usual Suspects. Who is Kaiser Soze? There's a line in there where he says, I believe the quote is, the greatest trick the devil ever pulled was convincing the world he didn't exist. And I think that kind of goes to answer your question, Joe. You're just trying to make an excuse for something, and that's making the devil not exist. Oh, it's the inflation's because of the $1,200 and $2,400 checks. That's not what that was all about. It was the rampant printing of money. So $1,200 checks, which a lot of people did get anyway. And fine, I guess those who were in lower income brackets, great. First off, how about we spend $500 and teach those people how to be more financially responsible with their money, right? Let's have them balance their checkbooks and show them income and liabilities and expenses. And let's get them to map out their finances first before you just give them another $1,200. It's going to go straight to Walmart and buy another big screen TV that they don't need. Don't get me started on that rabbit hole. But I think that it's important that the real truth comes out, which is the Federal Reserve was printing billions and billions, if not trillions and trillions of dollars. And I mentioned this one before. It was M1 money supply has gone from 1950, it was 2.5 trillion, and in 2020, it was 4 trillion. So over 70 years, it increased $1.5 trillion. Just 2 years later, M1 money supply was at 19 trillion, which means a $15 trillion increase in 2 years, where it took 70 to increase 1.5. That's crazy. That's what this is all about. And I'm sure that part of that is the $1,200, but that's a drop in the bucket. It was buying all the bonds and bailing everything out, and that was the real problem there. Anyway, I could go on a rant there. Yeah, maybe midterm elections, I think, is going to cause some of the volatility. One good thing about when elections are over is when they're done, you get a little bit better clarity as to who's in office and what their stance is, right? Certainly this has a lot to do with Democrats versus Republicans and their views on taxation and stimulus and things. But once you can see if there is in fact a shift to one side or the other, you can start to anticipate where the markets may be headed going forward. One of the ones we talked about a while back, and this is not me making a political statement, it's a fact. I always thought that the markets perform better under Republicans, and the bigger I dove into the actual statistics, they actually perform better under a Democratic administration, which I was kind of shocked about. But facts are facts. It's just straight statistics, and you learn about what the parties do to spend. Well, then it does make a lot of sense. Getting phone calls here. So, yeah, I don't know. Midterm elections don't really concern me too much. As you guys know, I'm really more about these price charts. I'll keep an eye on what's going on with these price charts. I'll update you on some of the trades I'm in, and hopefully they all pan out. If they don't, that's cool. I don't mind if they don't work. It's just I think the important part is that you guys see me make sure I take stop losses so I can practice what I preach to y'all. Okay. Let's see. There's a couple things here. TC, you had a really great question, but I'm going to have to save those for tomorrow. Let me bring up the earnings calendar. There were actually some big earnings this week, but I cannot remember off the top of my head who was reporting earnings. I usually prepare all that ahead of time, guys, but I was running late today. Let's see. Tomorrow. Oh, yeah. It's retailers. No, we had that horrible retail numbers last week, right? Retail sales numbers was really bad. Here's what you got cooking for tomorrow. Macy's, Medtronic, Nordstrom's, Advanced Auto Parts, Dick's Sporting Goods, Urban Outfitters, Intuit. Intuit's not really a retailer, but a lot of big retailer names coming out tomorrow with regards to earnings. So it should be an exciting one. Let's see. Tomorrow is Tuesday. I have no guests, so I will probably try to do a show specifically on... there's a few. TC had a really good question about what's called Biden bucks. Some people are freaking out about the Biden bucks. Was NVIDIA reporting tomorrow? I didn't think that they're reporting tomorrow. They're reporting, I think, on Wednesday. Let me real quickly check just to make sure. Yeah, NVIDIA's on Wednesday. Big up. Don't jump the gun, buddy. Don't jump the gun. So I'll probably do this thing on understanding the current administration stance on digital assets, because a lot of people are kind of confused about that and hearing all these crazy things. I'll talk more about central bank digital currencies or CBDCs and what the impact might be on our world. And if I make any trades tomorrow, I'll let you guys know about that one. And of course, more analysis. So if you guys enjoyed today's show, I see you've got our normal regular group, but I do see some new names out there. If you are new, hit that subscribe button, hit the little bell to get notifications when I start the show live, which I do every day at 2 p.m. Pacific time, unless, of course, I'm off on vacation or something else like that. So if you have comments, questions, feedback, really easy what to do. You can put your comments down below the YouTube video like Naum did. He put a whole ton of them down there, and I got through most of them. I'll try to get to the rest of those tomorrow. So down below any YouTube video I see through my control panel on any comment that comes through. So just put a comment in there and I will address it. You can also email me at TraderMerlin@gmail.com. As far as guests go, Wednesday, I'm going to have John Rowland on the show. We're going to talk about backwardation and contango, as well as anything to do with futures and commodities, natural gas and oil. And on Thursday, I'm going to have Corey Land on the program. We're going to talk about charting of options, because that was another question that came through. So those are 2 conversations that I'll have coming up here soon that were driven by your requests. So keep them coming in. You can email me, TraderMerlin@gmail.com, or down below the videos on any YouTube video. Thanks, everybody. I will see you all tomorrow. Take care.